Remember when Kodak stock exploded almost 20-fold in just 2 days back in 2020? Thousands of traders piled in thinking they'd struck gold, and most of them lost it all just as fast. That one moment captures the entire psychology of trading, the rush of sudden fortune, and the devastation that follows when emotion takes over. I've seen it happen to the average trader more times than I can count. And the truth is, I've felt that same pull myself. In this video, I want to tackle 3 questions that sit at the core of every trading mistake. Why do smart people lose money in situations like Kodak? What hidden traps in our own psychology keep us stuck repeating the same losses? And how can you build a system that protects your capital, not just today, but for the long run? Stick with me, because by the end, you'll see the market through a lens most traders never develop. A way to trade with clarity, calm, and control. And speaking of clarity, let's step into Zenstock. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. There's a book I keep coming back to whenever markets feel like they're spinning out of control. It's called The Battle for Investment Survival by Gerald Loeb. Loeb didn't sugarcoat the market. He warned that nothing is harder than consistently making money on Wall Street, and that most people rush in without realizing the dangers. When I first read his words, it felt like he was describing the Kodak moment decades before it ever happened. What struck me most was how blunt he was about human behavior. He wrote that the average trader gives less thought to investing than to almost anything else in life. Think about that for a second. We'll research a new phone for hours before buying it. But when it comes to putting real money into the market, most people just wing it. And that's why his perspective is timeless. The faces change. The tickers change. The news cycle moves on. But the psychology, the fear, the greed, the shortcuts, those remain the same. When I mentor traders today, I still see the same mistakes Loeb was warning about almost a century ago. People confuse luck for skill. They can't tell the difference between real knowledge and random noise. They think a hot tip or a big win is proof of genius. But as Loeb said, fools rush in. And on Wall Street, that's fatal. A few years ago, I worked with a trader who reminded me so much of that Kodak moment. He started with a clear plan. He told me he was only going to trade large-cap stocks, stick to defined risk, and focus on consistency. For the first few weeks, he did exactly that. His results weren't spectacular, but they were steady, the kind of foundation you can actually build a career on. But then he got distracted. He saw Red Hat suddenly spike on news and chatter about being a takeover target. Overnight, it became the stock everyone was talking about. He told himself it was a sure thing. So he broke his plan. He poured half his account into it. For a few days, it worked. His account shot up almost 50%, and he bragged about riding the wave. He was convinced he had spotted an opportunity no one else could see. And then the market turned. The same Red Hat position that made him feel like a genius collapsed on a pullback, wiping out nearly all of his gains in less than a week. When I asked him what happened, he admitted something I hear all the time. I thought I had control. I thought I could get out before it reversed. That illusion of control is exactly what Loeb warned about. The belief that we can outsmart risk, that we can always react faster than the market. It's a trap I've seen dozens of traders fall into, and one I've had to battle myself. The painful part? It wasn't the money he lost that hurt him most. It was the realization that his own psychology, not the market, had sabotaged him. And that's the lesson. In trading, the biggest danger usually isn't the chart in front of you. It's the mind behind the keyboard. So what does all this mean? The topic we're diving into today is survival. Not winning the lottery with a lucky trade. Not chasing the next Kodak or Red Hat moment, but building the mindset and system that keeps you in the game long enough to actually succeed. Because here's the truth. Anyone can make money in a single trade. Almost anyone can catch one lucky break. But without the right psychology, without rules that protect you from yourself, those wins evaporate. That's why this conversation matters. It's about rewiring the way you see risk, learning to spot your own blind spots, and developing habits that stack the odds in your favor. And before we go any deeper, Let me be clear. This is for education and entertainment only. It's not financial advice. Always do your own research before you put a single dollar into the market. Now, let's step back and crystallize this into one big takeaway, something you can carry with you every time you face the screen. If I had to sum it all up in one line, it would be this. Trading without discipline is like heading deep into the wilderness without a map or supplies. The trip starts out feeling like an adventure, but sooner or later, the elements catch up, and you realize you're not prepared to survive the night. That's the heart of Loeb's message, and it's the lesson every trader eventually learns, either the easy way through preparation or the hard way through pain. Lesson 1. Survival comes before profit. Loeb was blunt. Nothing is harder than consistently making money on Wall Street. He argued that the first priority isn't chasing gains, it's protecting yourself from being wiped out. That hit me hard when I first read it, because I'd already seen dozens of traders blow up accounts chasing the next big thing. Why did it resonate so deeply? Because I realized how backwards most traders think. The average person goes into the market assuming profit is the goal. But the truth is, staying in the game is the goal. If you can survive, profits eventually come. If you can't, you're done before you even learn. Psychology research backs this up. A 2019 study on day traders in Brazil found that over 97% lost money long-term, and only a fraction of 1% were consistently profitable. The researchers concluded the main reason wasn't knowledge. It was the inability to manage risk and avoid ruin. In other words, survival. I remember one friend I traded alongside early in my career. He was brilliant with charts, always spotting clever setups. But he treated every trade like it had to be a home run. When the market turned, his stop-loss discipline crumbled. He'd double down, telling himself he was managing the position. Within months, his account was gone. It wasn't his intelligence that failed him. It was his psychology. He couldn't separate his ego from his trades. He thought profits proved he was right, and losses proved he was wrong. That belief made him risk everything to avoid being wrong, and in the end, it cost him everything. Survival, not profit. That's the mindset shift. Protect your capital first, so you can come back tomorrow. Because in the market, there's always another trade, but there isn't always another bankroll. Lesson 2. Control your emotions, or your emotions will control your trades. Loeb wrote that the average trader fails because they can't control fear, greed, or the rush of chasing quick wins. He believed emotional decision-making was the most costly habit of all. When I first read that, it felt like he was sitting next to me, watching the mistakes I'd made in my own account. Why did this strike so hard? Because it's not knowledge that makes most traders fail. Everyone knows you should cut losses and let winners run. But knowing isn't the same as doing. The moment money is on the line, fear of loss and greed for more hijack your brain. Behavioral finance has proven this over and over. One of the most famous studies by Kahneman and Tversky showed that people feel the pain of a loss about twice as strongly as the pleasure of a gain. That's why traders often take profits too early, to lock in that pleasure, and hold on to losers too long, trying to avoid the pain. It's built into our wiring. I once mentored a trader who was terrified of losing. Every time he went into the red, even by a tiny amount, he'd immediately cut the trade. But when he was green, he'd sit there staring at the screen, paralyzed, afraid of giving it back. His entire account bled slowly, not from one disaster, but from 1,000 tiny paper cuts. He wasn't bad at analysis. His charts were solid. His timing wasn't awful. The real issue was emotional control. His trading decisions were driven not by logic, but by the spike of fear that hit his chest every time a candle turned against him. The breakthrough came when he finally realized, it's not about removing emotion. It's about designing systems that stop emotion from having the last word. That's why I use hard stops, predefined position sizes, and journaling. Not because I don't trust the market, but because I don't always trust myself. Loeb's point was clear. If you can't control your emotions, you don't control your trades. And if you don't control your trades, you won't last. Lesson 3. Over-diversification is just another way of avoiding responsibility. Loeb argued that scattering your money across too many stocks isn't protection. It's a way of hiding from the need to really understand what you're doing. He believed focus, not excessive diversification, was the smarter path. That idea cut against the "don't put all your eggs in one basket" advice I heard constantly when I was starting out. At first, it sounded reckless. But then I looked back at my own trades. I realized that most of the small, random positions I had taken weren't really hedging anything. They were just excuses, a way to avoid making hard choices about conviction and risk. Think about it. A trader with 20 positions isn't really managing 20 ideas. They're just hoping one or two will save them. That's not strategy. That's lottery ticket thinking. There's research that backs this up. Studies in portfolio theory show that the benefits of diversification level off sharply after about 15 stocks. Beyond that, the extra positions add complexity without meaningful risk reduction. In practice, most retail traders don't even analyze that many positions deeply. They just spread out because it feels safer. I'll never forget one friend of mine who did exactly that. He held a mix of tech, energy, and consumer names. On paper, it looked diversified. In reality, he hadn't studied correlations. So when the market corrected, all his stocks fell together, and his so-called diversification offered no protection at all. The painful part wasn't the drawdown itself. It was realizing that his strategy had been a lie, he told himself. A way to avoid the discomfort of concentration and accountability. Loeb's advice was sharper. Put your capital in your best ideas, watch them like a hawk, and cut them when they go wrong. Focus forces discipline. Diversification, if it's just random spreading, is an illusion of safety. For me, that was a turning point. I stopped thinking about how many stocks I owned and started thinking about why I owned them. That shift, from quantity to conviction, changed everything about how I approached risk. Lesson 4. Planned speculation beats accidental investing. Loeb believed that deliberate, planned speculation was actually safer than what most people call investing. His point was simple. Investors who think they're just in it for income often ignore the fact that inflation, market cycles, or a bad pick can shrink their capital faster than dividends can replace it. At first, this felt upside down to me. I grew up hearing that investing is safe, speculation is risky. But Loeb flipped that thinking. He argued that speculation with a plan, knowing why you're in, how much you're risking, and where you're getting out, is far safer than blindly holding stocks just because someone labeled them blue chip. The psychology behind this is huge. When people call themselves investors, they often stop asking hard questions. They assume time will save them. That's process versus outcome confusion, mistaking the label of being an investor for actually having a strategy. There's data to back this up too. A study of household portfolios by Barber and Odean found that the average investor underperformed the market by about 3 to 4% annually, mostly due to overconfidence and poor timing. Ironically, the very thing they thought was safe, holding without a clear plan, cost them more than active mistakes. I once had a colleague who swore he was a long-term investor. He held a major bank stock through a financial downturn, insisting it would bounce back. Instead, it cut its dividend, the stock price halved, and he sat frozen, watching his capital erode. His identity as an investor blinded him to reality. The breakthrough came when he reframed his thinking. He started treating every position like a speculation, with defined entry and exit criteria. It didn't mean he stopped holding long-term positions. It meant he finally had a plan for them, and that shift gave him control instead of excuses. Loeb's point still rings true. The danger isn't in speculation itself. The danger is in doing it unconsciously, without a plan. Planned speculation forces clarity. Accidental investing invites disaster. Lesson 5. The crowd is usually wrong. Loeb wrote that if you want to do better than drifting up and down with the crowd, you have to do your own buying and selling, your own thinking. He didn't trust the herd, because he knew markets are driven by fear and greed, not wisdom. That resonated with me the first time I stood on a crowded trading floor. Everyone seemed certain. Everyone had a hot take. And yet, if you had just done the opposite of the noise most days, you'd have made money. Psychology explains why. Social influence is one of the strongest biases humans carry. Experiments show that people will knowingly give a wrong answer to a simple question if everyone else in the room gives that same wrong answer first. In the markets, that effect is magnified by money and ego. When everyone's buying, the fear of missing out overrides logic. When everyone's selling, panic makes even solid positions feel unbearable. I had a friend who jumped into a stock rally simply because everyone on Twitter was talking about it. For weeks he watched the stock climb, convinced he was riding with the winners. But by the time he got in, the move was already exhausted. He bought near the top, and when the reversal came, he couldn't stomach the loss. He sold at the bottom, the exact opposite of what he intended. It wasn't the chart that betrayed him. It wasn't the company fundamentals. It was the crowd, or more specifically, his need to belong to it. Loeb's reminder is brutal, but freeing. The crowd is almost always chasing the past. If you want to survive, you have to think independently. That doesn't mean being contrarian for the sake of it. It means building conviction from your own process, not from the noise around you. For me, that was a turning point. I stopped asking, what's everyone else buying? And started asking, what's my edge here that the crowd doesn't see? That shift didn't just improve my results, it gave me the calm confidence to sit out trades entirely when the crowd was screaming the loudest. The patterns Loeb described aren't just theory. They've shown up again and again in market history and academic research. Take the dot-com bubble. In the late 90s, traders poured into internet stocks with no profits, no revenue, and no path to either. Over-diversification didn't save them, because when the bubble burst, everything collapsed together. The Nasdaq lost nearly 78% of its value between 2000 and 2002. It was survival, not selection, that determined who made it through. Or look at the financial crisis in 2008. Many so-called long-term investors held on to bank stocks assuming dividends would protect them. But as Loeb warned, income wasn't enough. Citigroup slashed its dividend by over 90%, and its stock dropped more than 95% from peak to trough. Those who had no plan beyond, "I'm an investor," were devastated. The same themes hold up in the data. In a landmark study, Barber and Odean analyzed tens of thousands of retail brokerage accounts and found that the most active traders underperformed the market by over 6% annually. Why? Overconfidence, emotional decision-making, and crowd following. The very traps Loeb wrote about decades earlier. Even in more recent times, you see it with Kodak's 2020 spike. A stock with no sustained fundamentals jumped nearly 2,000% on headlines, and then collapsed within weeks. The traders who survived weren't the ones who chased the story. They were the ones who had a plan and knew when to step aside. History keeps repeating itself because psychology doesn't change, and that's why Loeb's ideas feel just as sharp today as when he wrote them. When I look back at the traders I've worked with, and at my own mistakes, 3 psychological traps stand out again and again. The first is overconfidence and illusion of control. This is the belief that you'll know exactly when to get out, that you can outsmart risk in real time. It's what fueled that Red Hat story, and it's what destroys traders when a Kodak-type move reverses. The market moves faster than your brain does. If you rely on control instead of process, you're setting yourself up to fail. The second is loss aversion. Kahneman and Tversky showed that losses hurt about twice as much as equivalent gains feel good. That pain leads traders to cut winners too early and hold losers too long. It sounds small, but compounded across dozens of trades, it erodes entire accounts. I've seen traders literally sit on red positions for months just to avoid locking in the pain, while selling green trades after a day to feel relief. The third is social influence bias. When the crowd shouts, most traders listen. Social proof is wired into us. On Twitter, in Discord chats, even in CNBC soundbites, the herd becomes the compass. But as Loeb said, the crowd is usually wrong. Following the noise leads to buying at tops and selling at bottoms. These traps don't show up because traders are dumb. They show up because traders are human. And that's why the only real edge isn't more information, it's more self-awareness. So how do you protect yourself from those traps? 2 rules I live by, and they've saved me more times than I can count. Rule 8-1. Never enter a trade without knowing exactly where you'll get out if you're wrong. It doesn't matter how good the setup looks. If you don't have a clear exit, you're not trading, you're gambling. Loeb was right, survival comes first. This rule enforces that. Rule 2. Size your positions so that any single loss is just a paper cut, not a knockout punch. I tell traders all the time, if losing one trade wrecks your week, your size is too big. Consistency isn't built from giant wins. It's built from the ability to take dozens of small, controlled losses without flinching. Follow just those 2 rules, and you automatically sidestep most of the emotional traps, overconfidence, loss aversion, and crowd chasing. Because rules create structure, and structure creates freedom. Let me ask you a few questions. When you look at your last 5 trades, were they part of a clear plan, or were they reactions to the market's noise? If one of those trades had gone completely against you, would your size have been small enough to shrug it off, or big enough to wreck your week? And maybe the toughest one, are you trading to prove you're right, Or are you trading to survive long enough to be consistently profitable? Sit with those questions, because the answers will tell you more about your trading future than any chart ever will. Write down one thing you've learned from this video in the comments. Not a vague takeaway. A specific insight that you know you can apply in your next trading session. Then, share this video with a friend who might be struggling in the market, because sometimes the lesson clicks faster when you talk it through with someone else. And of course, like, share and subscribe. That way you won't miss the next deep dive we do here. Master your mind, master the market, trade with confidence and live with calm.